this is the year that I really need to move to better myself, right? What would the first step be? I know there are people know about, getting pre-qualified, but then there's also the pre-approval. And I feel that sometimes buyers kind of intertwine the two and they're not really sure what the difference is. Can you explain that to us?
Sure, absolutely. Pre-qualification is really just, it's a very basic overview. Typically credit will be pulled, but then, the customer is going to typically complete an application. They'll put in what they believe their income to be and their assets and things like that. It's just a very basic overview, and it's based on what the customer has input data-wise. The lender's going to say, okay, this is about how much you qualify for. What I encourage my customers to do is to do what's called a pre-approval. That's a step further where we're going to actually do a deep dive on their income and their credit and their assets. Typically, we're going to collect pay stubs, bank statements, W-2s, tax returns, depending on the loan program. A lot of times we'll even, for people that have a base salary, it's W-2, doesn't change, it's the same every month. That's a very easy calculation to do. A lot of folks have additional types of income, be it commission, be it bonus. They may be self-employed where their income's not the same every month. They don't know from
Right.
one month to the next.
Hmm.
So lenders are going to take averages, historical averages, depending on how they're paid. So a pre-approval would typically include, again, collecting the actual documents that an underwriter is going to use to fine tune those numbers. And I really recommend that all customers do that, even if they're W-2, because there can be surprises, but it's just a much more comprehensive analysis of what their actual financial situation is. And it will give them a much more defined and specific amount for what they qualify for. And there won't be any surprises later.
Okay. And the pre-approval is good for about 90 days, correct?
Correct.
Okay.
90 days is typical. It's based on how long the credit report is good for. So, and they can always be updated. It's usually just a matter of, providing an extra pay stub or an extra bank statement or something like that if it goes
Okay.
on those 90 days.
Okay. Excellent. Excellent. And then just one last question, just to kind of clear this up for anybody. I know I had wondered about this for a while. What is the difference between a loan officer and a lender? Are they the same?
Terms are used a little loosely.
Like agent and broker in our world? Yeah. Okay.
Yeah. And mortgage lenders are kind of broken down into three categories, I would say. So
Okay.
at the end of the spectrum, you've got a mortgage lender that works for a bank, and they're just able to offer their basically kind of their segment of programs.
Okay.
At the other end of that spectrum, you're going to have brokers. Brokers are going to have a lot of different investors, all sorts of different programs, be able to shop rates with a bunch of different investors to kind of see who's got the best one.
So they're not loyal to one institution like maybe a lender is.
Like a mortgage banker. So I would differentiate mortgage lenders into mortgage banker at one
Mhm.
end of the spectrum,
Okay.
broker at the other end of the spectrum, and then kind of the sweet spot in the middle, which is where I fit, is what's called a correspondent lender. So
Okay.
we have kind of all of the benefits of both sides. So for a mortgage banker, one of the things that is a plus there, they may have a limited toolbox of programs, but a mortgage banker typically is going to have direct access to the underwriter. So they
Okay.
can reach out and they can, explain a situation a little bit more differently, maybe finesse details that are a little bit more complicated. Mortgage broker on the other end of the spectrum, they've got all of these programs, but typically they don't have any direct access to the investor's underwriter. They're kind of working through an account rep, a third channel, and it's a little bit more of a disjointed process.
Okay.
Respondent lender in the middle, they're typically going to have tons of different programs, tons of different investors, but they also have the ability for their in-house underwriters to approve and underwrite for all of those myriad investors that they may have.
Okay.
There's more control over the process. And again, there's more opportunity to have consideration given for something that just maybe doesn't fit quite inside the box where maybe
Okay.
an exception can be given.
Right.
The process is always easier. Like I can pick up the phone and I can speak to my underwriters directly. I
Mhm.
can explain a situation with maybe the customer was out of work for a month last year, so their income looked a little off from what it should normally be, but there's more of an opportunity to explain that and get some additional consideration when you can actually speak to the decision maker.
Yeah, that sounds great. Okay, that makes a
I
huge
get
difference.
called broker, lender, loan originator, loan
Mhm.
officer. At the end of the day, it's really just different titles for
Yeah,
essentially the same function. People in those roles may have more or less control over the process, whether, depending on whether they're an actual broker or they're somewhere in the middle of that spectrum that I mentioned.
okay. When I was trying to come up with the thumbnail for this video, I was like, I'm going to call her a lending professional because I wasn't sure.
Which
So,
is
but
true.
now I know you are a correspondent lender, so that's good to know.
Yeah. And
Wonderful.
And really, at the end of the day, I mean, a loan officer, you can have a great mortgage broker, you can have a great mortgage banker, you can have a great correspondent lender. I think really the primary thing is finding someone who's experienced,
Right,
finding someone who really cares about your situation and isn't just trying to quote you a rate, throw you into a program and get on to their next client. Somebody that's really going to take the time to get to know each individual customer and find out, what they need.
right,
Most consumers are just programmed to call up and say, what's your lowest 30-year fixed rate today? I can give somebody a rate that's, in the 4%, but it's going to cost them an ungodly amount of money to do
right,
that.
right,
And so helping that customer really find out, do an analysis of the cost benefit, where
right. It's
that fine line where it makes sense to pay points. If somebody's going to pay a bunch of money just to save $50 a month, having an interest rate that's 1/4% lower, but it costs you, let's say, $20,000 more at closing to get it, it's not going to make sense.
right, right,
So
right,
having somebody that's going to really walk through with each individual customer and help them figure out what are their best options and kind of lay that out. At the end of the day, I'm really there to present options and to help a customer explore all of the options that they have. And then really kind of leave it up to the customer to determine what makes the most sense for them.
And as a real estate agent, if somebody says, they want to buy a house and I want it to be in Raleigh and I want it to be 4 bedrooms, I'm not just going to, send them a few houses. I want to have that buyer's consultation. I want to sit down with them. I want to know why they're moving. What are you looking for? What are you hoping to find in this home? And the way that I can do that is sitting down with them, having a face-to-face conversation and really getting to know them and their circumstance so that I'm putting together a search for them that makes sense. It's going to take them to the home that they want, not just any home, because everybody is an individual and you really have to evaluate everybody as an individual to see how you can cater to their needs. So I like that you do that as well. So that's
Absolutely. There's so many different ways to put things together. It's
yeah,
not always about just, putting 20% down on a 30-year fixed mortgage. There
right.
are
It's so much
so,
more. So
so
much
many
more.
different ways to put things together. There's a lot more flexibility with lending with regard to people that just have specialized income these days.
Yeah. Yeah.
It used to be in the past that people that were self-employed or, maybe had heavily commissioned jobs, things like that, had a difficult time getting financing.
Hmm.
And there are a lot more creative ways to really analyze somebody's ability to repay, because that's what a lender's job is really at the end of the day, is to make sure that anything that we offer and put a customer into, they have the reasonable expectation that they're going to be able to pay that and it's going to be comfortable for them in their lifestyle.
Definitely. Katrina, I want to thank you so much for being here today. I feel as though you've been super informative to anybody watching this video. You're an excellent resource. You've been in the business so long, so I know you've seen so much and have incredible experience. If anybody wants to get in touch with Katrina, I'm going to have her information down below. She is a lending professional here in the Triangle. She is one of our preferred lenders, and she's been super helpful today. Thank you so much, Katrina.
Thank you, Mandy. It was a pleasure. Thank you so much.